Good day and welcome to the KP Asset Market Report for the 6 months to the 30th of June. But because markets have done so much in the month of July and even into early August, and we're only recording this in August, we thought we'd give an update more to current. Right, starting with the CRB index, we'll go through this very quickly. Obviously, it's a very broad-based commodity index with everything from energy and metals through to a lot of agricultural commodities. This is really quite important more from an inflation point of view. As we can see, when COVID struck, it obviously hit the CRB index hard, and then suddenly the supply disruptions powered that ahead. And then once that was starting to moderate, we had obviously the Russian invasion of Ukraine, and that powered it higher still. It's been moderating, which is good news from an inflation point of view. But yeah, still obviously has caused quite a lot of chaos in global markets, courtesy of the tightening monetary policy it caused. All right, then on to metals, which is more important in a way for South African investors because we remain a fairly commodity-rich country, and commodities still represent quite a big part of our market. There's a lot of data points here. I think the important ones, if you look maybe over a 3-year view, you can see gold and silver have done better. Copper generally quite solid throughout, largely on fears around supply and continually solid demand. Whereas if you look maybe on a 3 and a 5-year view, the PGM is a lot less inspiring, with obviously palladium off 65% from those record levels a few years ago. But generally quite a mixed bag. And although the gold and silver has done well, arguably PGMs on average haven't kept up with the input inflation that the miners would have experienced. And obviously Brent is up, but if you look a lot more sort of muted than maybe some of the others, and it's also looking as though it's settling into a band. Iron ore again tends to be quite volatile with the anticipation of growth and demand, particularly out of China. But then we do get these anomalies, and if you look at the 3-year data there, you can see iron ore down 50%, but on a 5-year view, largely flat. And again, that would just for us reiterate the importance of being in tier 1 low-cost producers, and then copper generally doing quite nicely. All right, on to currencies. The rand over the last year or less has actually regained ground against all the major crosses. If you look slightly longer out, 3 years and 5 years, of course, it's weaker. But if you look much the same as it was 3 years ago as what we saw 5 years ago. So yeah, the big other important point on this, of course, is that if you look over the 3-year period, of course, the rand versus the pound less weak than it was, as well as against the euro, as opposed to significantly more weakness relative to the strong dollar and the strong Swiss franc. Whereas if we look on the 5-year view, only the euro is relatively weak, and you can see that also in the two columns on the right hand side, which is the dollar against the pound and the dollar against the euro, where if you look over a 3-year view, obviously the pound has been quite weak, as has the euro, but if you look over most other time frames, not that much different. All right, we thought this chart was quite important because I think South Africans in large part are pre-programmed to the view that the rand it will always weaken regardless of what level we're at. And this is quite an interesting chart because it goes back 10 years and it shows something that we believe quite strongly in, and that is that the rand tends to blow off in times of extreme weakness and volatility, often triggered by external events, although increasingly we sort of becoming quite good at doing this ourselves. But you can see, for example, Nenegate, and then the COVID sell-off. But the important thing that we're trying to highlight here is that after these blow-offs, you find that quite often the rand spends many years trying to regain its composure, and it actually feels in a way as though we're back into that zone, which is reinforced by the tables we just saw, or table that we just saw, which basically is saying that, you know, on a 1 year and less view, the rand has actually regained composure. Now, it's difficult to call currencies, but our gut is that, you know, there's obviously been a lot of money flowing out of South Africa, particularly with the Regulation 28 amendments, you know, the Foreign Investment Allowance amendments. But we sense that that tide has largely turned, and we've seen quite a lot of foreign interest in particularly South African bonds, but we feel that South African equities could also enjoy a little moment in the sun, and that could see this thing as we've seen in the past. You know, if you go back to 2016, early 2016, was at 17. You know, if you look then 2023, 6 years later, it was still at that level. So we're just cautioning against this mentality that the rand will always weaken from every level. All right, then very quickly we'll look at bonds, and we're going to not just look at yields, but we'll look at prices, because that's also quite important, because we've seen bonds offering a little bit of a capital gain opportunity, courtesy of the price weakness and the yields having run. All right, starting with the US, we obviously discussed this in the big picture in a lot more detail. You can see that although the 10-year has eased back from those sort of high levels that we saw late last year, that is still significantly higher than it's been on average for the last 10 years. And if we then look across to bond prices, this is the iShares US Treasury ETF, you can see that those prices have come off very, very significantly. And I think we've been warning for a very long time that, you know, this mindset of accepting very, very low yields, particularly in Europe, was a little bit dangerous. But we do see now an opportunity to A, lock in a bit of yield, and B, that we do believe there might be some capital gain to be seen. Although you've always got to moderate this with our fundamental longer term concern about US debt and the fact that there's just too much debt in issue. Looking at the Eurozone, obviously a similar picture, although the absolute moves are not maybe quite as pronounced. But this is what we were talking about, this sort of, you know, 2019 to 2022 period where, or into 2022, where yields were at times even negative. And you can see even more pronounced price changes there. So, although, you know, the relatively low yields in Europe make it considerably less appealing. All right, the UK 10-year yield, very similar in large part to what has happened in the US. Yields generally followed, were even slightly lower at a point sort of in 2020 with the COVID sell-off. And you can see prices there have also come off quite significantly. Just as we have some concerns about debt in the UK, in the US, we also are a little bit anxious, particularly because of, you know, the Labour government and some of the noises from there. But yeah, we do see more merit in US and UK debt than we have for some time. Very quickly on South African bonds, you can see a very, very nice rally recently post the Government of National Unity, you know, with the 10-year now down to around 9.5%. You can see there were times not so long ago where it was up at 11. And then looking across at the SA Govie Index, which has obviously got longer dated bonds in it as well, you can see a very, very significant move. You know, if you take that index level of sort of 760 up to the current 839, investors in government bonds in South Africa have actually seen quite nice capital gains. We sense that there's still some yield pickup, but we think that maybe the easy money has probably been made in South African government debt. And just like we have concerns around US debt, of course, there's always that sword hanging over the heads of bond investors in South Africa because of the debt trajectory. And although you know, we're all hopeful about the Government of National Unity, we need to be mindful of the fact that South Africa's debt has significantly increased, and debt servicing costs are going to become a bigger deal. So yeah, we don't see much more capital upside for South African government bonds. Then global equities. We'll try and go through these slides quite quickly. There's quite a few of them. Starting out with the recent performance in some of the major global indices. Again, lots of data points here. I think the key thing, this is the shorter term data. The column on the left next to the heading is the 1 month to July. Everything else is then up to the 30th of June. As you can see, the Nasdaq on a 1 year view to the 30th of June was the star performer, being up 30%, and as we'll see, that propelled the S&P 500, whereas a lot more pedestrian performance out of the Russell, which is a broader based index, as well as if you look at the more recent performance out of the UK and Europe, also looking fairly dull, and then of course China and Hong Kong continue to battle. In the month of July, we can see the Nasdaq coming off the boil. We'll have a look at some of those drivers in a second, but interestingly, a flip into the Russell, so into smaller caps, but generally the month of July was difficult for global equity markets. Looking at the longer term data up to the end of June, once again, the Nasdaq over 5 years up in capital terms 157%. That powered the S&P by 86%, and you can see once again the Dow and the Russell lagging quite significantly, and then the FTSE 100, very much like South Africa, it's been disappointing. Brexit probably having its role to play there, and then interestingly the Stocks 50 over a 5 year view, probably powered by the likes of ASML and a few others, has done quite well, and actually not that different from what, for example, the S&P 500 has done on a 3 year view, and then China and Hong Kong continue to look awful. So, as we said, the S&P 500 really was the star performer. This is a 10-year chart. As you can see, up to 2022, markets rallied hard, and then, after that eased back, and then more recently we've seen technology powering it forward. What you've got here, busy chart. I'll be quite quick on it. If you look at the top holdings in the S&P 500, the top 10 represents about 36%. And all other than Berkshire and Eli Lilly are effectively technology or technology-related plays, and that's confirmed in the top sector allocation, with information technology representing almost 33%, and virtually as big as the next three, being financials, healthcare, and consumer discretionary. That in large part was powered by Nvidia Corp. You can see this chart is the market cap of Nvidia. And it's just been a phenomenal run from beginning of this year, around $1 trillion, all the way up to touching $3 trillion. And that's seen it, catapult up to the second biggest holding in the S&P 500. Okay, so it's not just Nvidia. We spoke about this before, the Magnificent Seven effect. As we can see here, that red line on the top and this data is slightly stale. It's up to the end of March, and it's courtesy of Fort and Bloomberg. You can see that over the 15 months from January 23 to March 24, the Magnificent Seven more than doubled, whereas the S&P 500 up around 40%, compared to the S&P X, the Magnificent Seven, only up around 22%. So that'll just give context for how significant the impact of the Magnificent Seven and what we would call this AI boom has been. Sadly, gravity then kicked in, and I think in large part because of that very busy chart on the left, which shows the PE ratios of a few of the companies. Obviously, companies like Tesla being afforded a lot of blue sky potential, but generally we would say, PEs of 30 to 40 times. And the reality, though, is a lot of these businesses haven't got the potential to deliver the kind of earnings growth that is necessary to justify 30 or 40 multiples, or be they good companies. If you look at companies like Microsoft, for example, great business model, but really not a 30% earnings growth story. So Eventually, Gravity took over this little table here, which is just an extract from Reuters. You can see the data to the 14th of August. The 1 month and the 3 month performances, the likes of Intel over 1 month down 40%, Micron, which we hold, although we did trim some, down 27%, AMD and ASML down around 22%. So the sell-off here has been quite significant. Tesla on a 3 month view is firmer, but obviously over a month is weaker. And this also, I think, is just, if you look at the difference in the performances on the 1 month and the 3 month, it just tells you how much volatility we're actually seeing in these sectors. But the bottom line is definitely the shine has come off over the more recent past, the Magnificent Seven. So technology didn't just power the S&P 500. A lot of people would look to the MSCI World Index, and as you can see in that table on the bottom right, that's the top holdings, and you can see your usual suspects: Apple, Microsoft, Nvidia, etc. Once again, same suspects. And you can see technology, it's a bit difficult to read, but technology representing about 25% of the MSCI World Index. And that's really just because around 73% of the MSCI World is effectively made up of those S&P 500 constituents. So it powered the MSCI World Index, but it's also now starting to come off. All right, then the Nasdaq, obviously we've largely covered. You can see a phenomenal rally over the last 18 months or so, but definitely coming down to earth with quite a bang. The FTSE 100, as we said, has been very dull for an extended period of time, but it does look as though it's starting to build up a head of steam, back almost in record territory. And we actually see quite good value in a lot of, almost more in UK equities than any others from a global point of view. Stock 600, similar picture. Of course, the Stock 600 still got quite heavy weightings in a handful of shares, and we saw weakness in some of those in that previous table. And that's seen a little bit of a pullback, but Stock 600 has done very, very well over a 10-year view, although arguably a little less so from its, say, 2022 starting point. CSI 300, Chinese mainline index, it's been very, very disappointing. It's just been in a phase of almost structural decline from a share price or from an index point of view. We see quite good value here. We understand the anxiety around shadow banking. We understand the anxiety around the commercial property market, but we do think that those fears are overdone and there's merit in China. Moving on to South African equities, once again a very busy chart, similar picture where we're talking about the periods up to the 30th of June in the 4 right-hand columns, and then the more recent up to the end of July. As you can see, I think the bottom line is a fairly mixed picture. The worst performer, let's say, take a 1-year view by some way, is telecoms. Obviously, the sector itself is under pressure, and then the companies within the sector have obviously, some of those have had their own challenges. On a 1-year view, all share disappointing, 5%. Top 40 up 3%, but as you can see, some of the other indices, local industrials, listed property, small caps, mid caps, and banks, all doing very, very nicely. And interestingly, in contrast with what we saw in July, where global markets were actually on average quite weak, South African equity market did much better in spite of weakness in tech, which is really Naspers. Although the all share was up 4%, you can see better performance from some of the consumer stocks and banks and even basic materials, small caps, mid caps. So July was a very good time for the South African market. Looking slightly longer term for South Africa, if you look over a 10-year view, I did the calculation the other day, the compound annual return is under 5%. If you look at some of the mainline indices, and of course, if we'd had the likes of the capped Swix over that extended period, you would have seen even more underperformance. So once again, we've seen kind of a two-speed economy. If you look over 5 years, indices like industrials, listed property, and telecoms basically doing nothing. Banks over a 5-year view up 22, but over a 3-year view also capturing some of that weakness around COVID, up 55%. So, I think the South African equity market, we've said it before and we'll say it again, it's like there's a finite pot of capital that just sort of rotates among the sectors, but you do get the feeling that appetite for local economy stocks, for example, as we're seeing in the small caps, mid caps, banks, some of the local industrials, definitely looking better. And we'll just unpack some of that quickly in some of the price charts, as we were just saying. If you look over a 10-year view until quite recently, very, very disappointing performance from the broader South African market, the all share. Technology, interestingly enough, has actually underperformed. Of course, the components of that technology index would have shifted over the years, but it's also telling you that, Naspers, for example, after hitting these record levels, and Process obviously have settled slightly lower. And then consumer goods, of course, we've seen a couple of those consumer stocks in the likes of Richemont doing very, very nicely. Banks have also done very well in the recent past, but up until that point over a decade, very, very disappointing performance. Basic materials, our view is that they are cyclical in nature, and that's exactly what we're seeing here. Interestingly, not that we are technical analysts, but it looks as though that index is actually breaking its 200-day moving average on the way down. And we are very underweight basic materials for obvious reasons. Industrials have also done well, more the local industrials, particularly more recently. Telecoms has just been a disaster. We've seen what the likes of MTN have done, and very happily we have no telecoms exposure at all. Mid caps, very disappointing over the 10 years up to the beginning of 2024, but as the GNU sort of took shape, you can see a lot more optimism, and also I think value investors sort of, I wouldn't say flooding into the market, but snapping up bargains. And then JSE small caps have been disappointing for a long time. It's a funny index. It's not very representative of small caps, but it's a good barometer for the mood towards small caps, and we've seen it in our portfolios. Local economy small caps have done very nicely. Property, global property, still well down on when it was a decade ago in spite of a recovery. We remain weary of particularly the office and the retail market, and a similar story on the South African scene. So, although we're seeing a recovery in South African listed property, we remain anxious about cost pressures, etc. So, in conclusion, our reading on the bond market, both global and local, is that the real story is still around a yield pickup rather than capital gain. We think that particularly in SA, probably some of the easy money has been made already. But if you look at what we think interest rates are going to do both locally and internationally, I'm talking about money market rates, it probably makes sense to lock in some yield in particularly the medium end of the curve, both local and in certain offshore markets. Our reading on global markets, global equity markets rather, is that there's definitely more volatility around. If you look at the daily vol on the S&P 500, for example, it's up significantly on where it's been on average over the last couple of years. So you do get the feeling that the markets are kind of recalibrating. We do think that there's some vulnerability, particularly in more highly valued counters. We've seen the tech sell-off where those multiples were unsustainable, probably. We do see value in certain markets, particularly probably in the UK, but China also looks quite interesting. And that's probably more of a sort of a tactical bet, just based on our assessment of the long-term prospects for that economy. Local equities, we see local economy stocks will probably continue to do well unless we get a wobble on the GNU. Globally oriented stocks, it's very stock specific, very sector specific. So you've seen, for example, companies like Aspen, which have significant offshore exposure, having done very, very well, whereas some other counters, things like British American Tobacco and Anheuser-Busch over seasons have done fairly poorly. We still think, in spite of the rally in local economy stocks particularly, that value is evident. I think commodities, we don't have it as a bullet point, but commodity stocks are looking better than they have from a share price point of view, but you've really got to pick your stock quite carefully. BHP still stands out as our preferred pick in the sector, but it probably needs to give back a little bit more. And then finally, property, the yields look compelling, but the fundamentals remain uncertain, particularly in South Africa. And we do think that there's a kind of a fundamental shift happening in global property. As we said before, we tend to favor more of the DCs and logistics hubs and so forth, so more e-commerce driven kind of property plays. But for now, we'll probably just sit that one out. Well, that's really it from an asset market review. We trust this has been of value and interest to you. As we've always said, this follows on the big picture, and from here we suggest you move on to the local and the offshore portfolio review. And for those with interest in the Kerner BCI fund, obviously you can watch that one. We really do welcome your feedback, positive or negative, on the format and the content, and we thank you very much again for your time and attention.